Bismillahirrahmanirrahim. Subject is financial statement analysis. In today's topic is on analysis of inventory. But in this lecture, we will discuss numerical illustrations in order to understand different valuation method of inventories and its impact on financial statement, specifically on cost of goods sold statement and ending inventory that has appeared on the face of the balance sheet. So we will cover topic in this lecture are illustration to examine inventory valuation, impact on valuation method on inventory, cost of goods sold or cost of sale, operating cash flow, net income, cash balances, inventory related ratios. Now, since we discussed in our earlier lecture that there are different valuation method of inventory, so we will check inventory valuation method impact on ending inventory, impact on cost of goods sold, that is typo, goods sold, in cost of sale, impact on operating cash flow, net income, cash balances, and inventory related issue. We will take example of Caterpillar, abbreviated as CAT in USA. Caterpillar is Caterpillar Incorporated is based in Peoria, Illinois, USA. Is the largest maker of construction and mining equipment, diesel and natural gas engines, and industrial gas turbine in the world. Excerpts from Caterpillar's consolidated financial statement are shown in Exhibit 1 and 2, and notes pertaining to Caterpillar's inventories are presented in Exhibit 3. Assume tax rate of 20% for 2008 and 30% from the earlier years. The assumed tax rates are based on the provision for tax as a percentage of consolidated profit before taxes. We will ignore the 35% corporate or statutory tax rate of US taxation our revenue department. We will just assume that is 30% tax rate on consolidated profit for the earlier year and 20% for the 2008. What are the requirements for this question? We will calculate value of inventory. Since this company is using LIFO method for inventory, so what will be the value of inventory if this company adopt first method, FIFO method? Second requirement is cost of sales or cost of goods sold for 2008-2007. If the company used FIFO method, currently it is using LIFO method. So if it is used FIFO method, what will be the cost of goods sold? Third, we are required to recalculate net income or profit for the assumption if the company use FIFO method instead of LIFO method. The company currently using LIFO method. If the company shift to this method, what will happen to the net income? Fourth requirement, what will happen to the net cash flow? From operating activities decline if it used FIFO method instead of LIFO method. Means we will calculate net cash flow as well. Fifth requirement is what is the cumulative amount of income tax saving that the caterpillar has generated through 2000 by using LIFO method, last in first method instead of FIFO method. What would happen to the to the income taxes? What amount would be added to the caterpillar retained earnings? That is in the balance sheet. Profit implied for the business's other name used in USA. At the end of December 2008, if Caterpillar used FIFO method, means shift to FIFO method instead of LIFO method. Seventh requirement is what will happen to the changes in cash balances if Caterpillar had used FIFO method instead of LIFO method, because in America or in USA LIFO method is used for tax saving purposes. So this is the current adopted method of inventory valuation. If the company shift to FIFO method from LIFO, what would happen to the cash balances? In eighth, we will calculate a requirement 2008 under LIFO method, FIFO method, inventory turnover ratio. Inventory turnover ratios in days, gross profit margin, net profit margin, return on assets, current ratio, and total liability to equity ratio. This is first exhibit 1. That is net income or result of operation, sale of machinery and engines 2008, 7 and 6. Revenue from financial product. Since this is consolidated balance sheet, so may have the Caterpillar have some subsidiary companies who are dealing in financial product. This is total revenue. Cost of goods sold from engine for 2007-6, while interest expense on financial product is this one. Now total operating cost, operating profit. Operating profit is the result of operation continues from the previous slides. So interest expense that is not pertaining to the financial product. Other income or other expense that is reported here. So this is consolidated profit before taxes. This is tax. Now consolidated profit in for the company's shareholder, and this is for the minority shareholders. Total profit is that much. It is allocated into total profit, or the profit is allocated to minority shareholder and the consolidated companies. Now exhibit 2, Caterpillar Incorporated consolidated financial position, that is balance sheets. Some figures are deliberately excluded, but those who will need in calculation are included here. This is cash and cash equivalent or short-term investment, that is inventory, that is total current assets, and that is total assets. Other things are deliberately excluded. Liabilities, that is current liabilities, that is total liabilities. Now redeemable non-controlling interest, minority interest, which is called that is only appear in consolidated balance sheet. Shareholder equity, this is authorized capital, this is issued capital, this is treasury stock held by the company, which will be deducted from overall equity. This is the retained earning or profit implied in a business. This is accumulated or other comprehensive income, which is losses. This is total stockholder equity for 2008, for 2007, for 2006. That is total liabilities in stockholder equity. Now we are moving further to exhibit 3, what Caterpillar considered notes to the financial statement says about the inventory. Operation is some of significant accounting policy. Inventories are stated at lower of cost or market value. Means if the cost is lower, we will report it on cost. If market value is lower, then we will report the inventory on the market. Cost is principally, now since we will calculate first cost of inventory, cost is principally determined using last in first method. In United States, the value of inventory on LIFO basis represent about 70% of the total inventory. On December 2008, 75% of the total inventory for December 2007 and 6. It means that if there is 1000 in the balance sheet, if that is inventory amount is 1000 during 2008, only 70% of this will be, let me 70% of 1000 means 700. Inventory 700 value will be calculated on the basis of LIFO method. Moving further, if FIFO first in first method had been used, it is also given to you if the company used first in first method instead of last in first method, LIFO method had been used, inventory would have been 3,183 million higher in 2008, $2,717 million will higher in 2007. In 2004 was 3 million higher inventory in 2006. So means if the company adopted FIFO method, its inventory value will increase by this method into this amount in 2008, this amount in 2008, 2007, and this amount in 2006. So this is basis for our calculation or solving the questions. Now moving further, exhibit 3 is still here. So consolidated inventories for 2009 is under raw material, work in process, finished goods and supplies. That is total inventory is 8,781, 7,204 in 2006, 6,351 in 2006. This is inventory amount. These are the basis for our calculation in this question. Moving further, this is again in notes to the financial that we had a long-term material purchase obligation of approximately 363 million at December 2008. Means we are not liable to pay it in a short term. It is long-term material. Requirement number 1. What will happen to the inventory? We will discuss requirement number 1, but there's a problem in the slide, so we will discuss requirement number 2. What will happen to the cost of goods sold? This is cost of goods sold which we extracted from exhibit 1. Now, how much increase have happened in in the amount of, if we are using FIFO method. So if we are using FIFO method, this inventory increase by that much, 214. So we will deduct it from the cost of goods sold, because this amount will be retained in inventory. And from 2007 to 2008, inventory amount increased by this amount, so we will deduct it from cost of goods sold, and it will be in the and it will be included in the inventory. So cost of goods sold under FIFO method reduced to 37,849 and 32,412. Now, how this amount is calculated? Since from 2006 this amount to 2007 it increased by 214, while this is in 2017, and when we deducted it from 2008 it is 566. So inventory increase from one year to another under FIFO method means that this amount have been shifted to inventory, while cost of goods sold will have to be reduced if it is calculated under the LIFO method. Requirement number 3. What would happen to the net income? Since cost of goods sold have been reduced, net income for 2008 and 2007, cost of goods sold have been reduced by 566 and 214. So net income will be increased by this amount. Along with this, if we will calculate income tax as well. If when net income increased by 566, we will apply 20% to it, which is 113. When we apply 30% to 14, sorry, this is a typo, we will have to calculate it again, which is 214 multiplied by 30%, this is 64.2. 64.2, because tax rate is 30 in 2007 and 113 in 2008. Now, net income under FIFO method will be increased to 4,010 million and 3,691 million. Now, this is what we calculated is 20%, 113 is tax, and 214 multiplied by 30%, that is 64 million. So net income will be increased by this gross profit when we reduce the cost of goods sold by this amount, and along with this we will also apply for the higher income a taxes. So only this amount will be taxed because it is incremental. So tax increase according to this amount will be $113. Tax amount according to this incremental amount will be 64.2 million. So under FIFO method, net income would be increased. Requirement number 4. What would happen to the net cash flow? According to LIFO method, net cash flow from operating activities limited to the impact of changes in the income tax paid, changes in allocating inventory cost to ending inventory and cost of goods sold do not have any change in the cash flow except in income taxes. Only income tax will change the cash flow. So as a result, what would happen? The effect of using FIFO method, first in first out method, Caterpillar net operating cash flow from operating activities would be declined by 113 million in 2008 and 64 million in 2007, because we will have to pay extra income tax in 2008 and 64 million in 2007. These are approximate incremental increase in income taxes that Qatar would have to incur if FIFO method were used instead of LIFO method. Moving further, requirement number 5. Assuming tax rate of 20% for 2008 and 30% for earlier year, the cumulative amount of income tax saving that Qatar generated using LIFO method instead of FIFO methods are approximately 899 million. So 113 plus this multiplied by 30%. So total amount that is saved by the Caterpillar using already existing method, LIFO method, is 898 million dollar. Now, since note 1 indicate that LIFO reserves is 2,617 million at the end of 2007, an increase in LIFO reserves 566 million in 2008. So we calculate this according to this calculation. Now, FIFO method cumulative gross profit would have been this much million higher at the end of 2007 year, and additional 566 million higher at the end of 2008. The estimated tax saving would be higher if the tax rate is higher. If the tax is lower, then the estimated saving would be lower. Requirement number 6. The amount that would add to retained earnings is how much? Since this is total income increase in 2008, but total saving is this much. Total taxation, which is calculated, is according to this formula. This represents cumulative increase in operating profit due to decrease in cost of goods sold, that is $3,183 million. Let's assume tax that profit would have been paid. So it is calculated in solution 5. Now total increase would be total increase in the gross profit minus increase in taxes, that is $2,285 million would be added to the retained earnings. Now what would happen? It would happen that this amount will be increased to will be added to deferred taxation. Which will increase your long-term liability, while this amount will be increased to retained earnings. This is second opinion. Some analysis shows that it would be grossly increase net income and it would be grossly increase the long-term liability. That ignoring tax consequences suggests that simply adjusting inventory and equity by the same amount, they argue that reported equity of the firm understood by the difference between current value of its inventory approximated by value of under FIFO and carrying value under LIFO. Requirement number 7. What would happen to the tax expenses? If Qatar switched from FIFO, it would have additional tax liability of 898 million as a consequence of the restatement of financial statement to FIFO method. This illustrates a significant immediate income tax liability that may arise in the year transition from LIFO method to FIFO method. Since the company will not immediately pay it, so there will be no impact on the cash balances. What will happen to the cash? Now, switch to FIFO. For the tax purposes, it would be a cash outflow for additional taxes. However, because the company is not actually converting at this point for either tax or reporting purposes, it is not appropriate to reflect the deferred tax liability rather than reduction in cash. In this case, for analysis purposes, under FIFO, inventory would have increased by this amount, and equity would have increased by this amount, and non-current tax liability would be deferred tax liability would be increased by this amount. Now, what would happen to the inventory turnover ratio? This is cost of goods sold under LIFO method. It would be divided by average inventory, which is this ending plus closing divided by 2. Inventory for 2007, inventories for 2008 divided by 2, which is LIFO method 4. Inventory turnover ratio is 4.81. And under FIFO method, this is your cost of goods sold, this is your average inventory, so it would is 3.47. The ratio is higher under LIFO method given rising inventory cost. Cost of goods sold will be higher under and inventory carrying amount will be lower under LIFO. If the analyst made no adjustment for the difference in inventory method, it would be deducted. The company using LIFO method manages its inventory more effectively, but it is not using effectively the inventory, but it is using just LIFO method that is quite different from FIFO method. So days in inventory, we will calculate days in inventory by number of days in a period divided by inventory turnover ratios. That is 366 days in a year because 2008 was a leap year divided by inventory ratio. So under LIFO it is more effective because it converted inventory to finished goods in 76 days. But 366 under FIFO method divided by 3.47, it takes 105.5 days to convert its inventory into a finished into a cash. So it seems apparently that LIFO method is quite best in handling inventory, but it is a method. It is not actually they are handling the inventory in effective manner. Now, what would happen to the gross profit margin? Gross profit margin is equal to gross profit divided by total revenue. That is gross profit under a LIFO. This is sale minus cost of goods sold. Sale minus cost of goods sold. So gross profit under FIFO method is lower is compared to gross profit under LIFO method. So the gross profit margin under FIFO appears or seems better than the LIFO method. So revenue of financial product is excluded in this case because we just calculate it for the engines and hardware sale, that machinery and engines. This cost of goods sold. So the gross profit margin is lower for LIFO because the cost of goods sold is higher given rising inventory cost. What would happen to the net profit margin? Net profit margin would also be high for the FIFO method. Net income divided by total revenue. This is net income under LIFO divided by total revenue. This is net income under FIFO divided by total revenue. So that is 6.93%, that is 7.81%. Seems better in FIFO rather than under the LIFO method. What would happen to the return on asset? Return on asset can be calculated as net income divided by average total asset. Net income increase under FIFO method. That is 6.18% and that is 5.74. This is what happened to the inventory. inventory increases, so total asset increases. Inventory increases, so total asset increases, divided by 2, that is average assets. That is, but asset not proportionately increases as higher as the as the net income increases under the FIFO method. So the effect of increase in asset is lower as compared to increase in the net income under the FIFO method. So the company appears to be profitable under the FIFO method rather than under the LIFO method. What would happen to the current ratio? Current ratio is equal to current asset divided by current liabilities. Since liabilities do not change, but current asset change under FIFO method. It is 1.31, it is 1.21. That is bit higher than this one. It appeared to be seen better. The current ratio is lower under LIFO primarily because lower inventory carrying amount. The company appears to be less liquid under LIFO method. So total liability to total equity ratio is calculated total liability divided by total shareholder equity. Total liability in this case is that much divided by this amount. Now total liability plus 898 divided by total shareholder equity plus, which is increase in retained earnings during 2008. So under a LIFO method, it is 10 total liability to total equity. It is 7, means that we are using a higher equity as compared to LIFO method. So the ratio is higher under the LIFO method because the addition in retained earnings under the FIFO reduces the ratio. The company appears to be more highly leveraged under a LIFO method. Solution 8. What happened if we have a glance at the table? We concluded that company appears to be less profitable, less liquid, and more highly leveraged under a LIFO method. But the company value is based on the present value of the future cash flow. LIFO will increase the company value because cash flow are higher in earlier year due to lower taxes. LIFO method is primarily used for the tax benefit in United States. This is all about today's lecture. Thank you.